So good afternoon, everyone. My name is Maurya Hanspal, and in this session, we're going to continue our previous sessions on portfolio management. And in the previous session, we started our discussion on analyzing that what exactly do we mean by a portfolio, what is the benefit of creating a portfolio, and what is the strategy of diversification. Then we also started to analyze the different types of risks, that is the systematic risk and non-systematic risk. Your non-systematic risk is also called the diversifiable risk. The risk that can be diversified away, like by creating the portfolio strategies or diversifying your portfolio. That is just of investing into like one kind of industry or one kind of stocks, investing into the different industries. And the second thing that we talked about was the systematic risk or the non-diversifiable risk. And that is the risk which cannot be diversified away by creating the portfolio strategies also, because that is ultimately the market risk. And the market risk, it cannot be controlled even by creating a portfolio. And like when we talked about the measures of the non-systematic risk or diversifiable risk, it was the error term, the standard deviation or variance. And when we talked about the measure of systematic risk or non-diversifiable risk, that was something called as beta. And then we talked about what exactly is a beta. Then we also tried to understand how to calculate the beta by using the covariance and variance method, and also by using the function of slope on Excel, which was the easiest method to do so. We also try to understand the concept of the intercept. Intercept was nothing but the exit return over the benchmark. Right? So that we try to understand. And that benchmark can be anything. Like for example, if you are comparing your market return, okay, so you can compare your market return over the risk-free rate. So that can be the benchmark in that scenario, because obviously the market will give you some more return as compared to the risk-free rate, because the risk-free rate is something which is as per the government securities, your government bonds, your government notes, your government bills. So all these possess a risk-free rate, because and the risk-free rate is nothing but the rate of interest that these government securities are offering on their securities. And why the rate of interest is very low on these securities? Because ultimately these are secured by the government, and the government won't default on their payments. And just in case the government defaults on their payments, so that can create mistrust or a situation where the people won't trust the sovereignty of the country, and as well as the trust and the faith upon the government would be lost. So that is the reason the government won't default on the payment of such kinds of securities. So that is why, like when we talk about the return on market, that return on market, we talk about the return on the benchmark, and that is your Sensex or Nifty. So obviously, Sensex or Nifty would be giving you some more return as compared to the risk-free rate. And why? Because ultimately you have invested into equities. Similarly, the benchmark can be different as well. Like for example, if you have invested into an active mutual fund that tries to beat the index, in that case, the main purpose of the active mutual fund would be to beat the benchmark. In that case, the benchmark would not be the risk-free rate of the government securities. The benchmark would be the Nifty or Sensex, because ultimately the main role of an active fund is to beat that index, right? So in this session, we had to start a discussion talking about the CAPM model, the capital asset pricing model. So C stands for capital, A stands for asset, P stands for pricing, and M stands for model. And that is a capital asset pricing model. And capital asset pricing model is used to find out the cost of equity. Okay, it's used to find out the cost of equity. And cost of equity is nothing but the minimum return which the persons are expecting. If someone has invested into the equity of the company, or in layman terms, if someone has bought the shares of the company on the stock exchange, he expects a minimum return, right? So ultimately, the cost of equity, it determines the minimum return that that person would be getting. So cost of equity is nothing but the minimum average return that a person is desiring from his investment. Now, his investment can be in terms of bonds, his investment can be in terms of government securities, his investments can be in terms of the cryptocurrencies or commodities or forex market also. But this particularly the CAPA model, the most well-known model, is used for the formulation of the cost of equity or to calculate the cost of equity. So it gives you the formula as the risk-free rate plus your beta, and we all know that what's beta? It's a proxy of systematic risk into RM minus RF. RF is the risk-free rate, that is the rate of interest on government securities. B is the beta, the measure or the proxy of systematic risk. RM is the return on market, that is your benchmark market index, Sensex or Nifty. And again, RF is the risk-free rate of return. And this is the excess of the return on market, which can be your Nifty or Sensex over the risk-free rate. And this difference, we call it as the market risk premium. So higher the market risk premium or higher the risk that you are taking in the market, higher would be the cost of equity ultimately. So for example, the risk-free rate can be 6%, the beta can be 1, the RM can be like 15%, and the risk-free rate can be 6%. So when we calculate it, like these are just the random numbers that we take. Okay, like just for the sake of calculation, I'm making you understand. So when we calculate it, 15 minus 6 is 9, 9 into 1 is 9, and 9 plus 6 is 15. So 15% you get the cost of equity. Okay, so that is a major model. And in the CAPM model, what are we assuming? We are assuming that the portfolio is completely diversified, that there is no unsystematic risk. Only the systematic risk is here that cannot be diversified away. Whereas in further enhancement of these models, like when someone tries to enhance these models, sometimes people also use the error term ahead, and that is to represent some unsystematic risk. And some people also try to use the size premium, and the size premium is nothing but your small cap companies minus the large cap companies. Why? Because over the years, the small cap companies have given you more return as compared to the large cap companies. And why? Because these large cap companies, be it your Reliance, your HUL, your Nestle, your Britannia, all these are the top market capitalized companies. All these are stable companies, and the potential for growth, it might be there, but that potential would be less. Or like if these companies grow also, the rate of growth would be like very less, because these companies have almost like realized their full potential and they are at the saturated point. But when we talk about the small cap companies, these companies have a potential to grow in future, and the growth rate of these companies is much higher than the large cap companies, and that we need to understand, because these companies are the small one and they're having a market capitalization of less than 5,000 crores, whereas the large cap companies are having a market capitalization of more than 20,000 crores. So see, so much scope these small cap companies have, and that is why the small cap companies are more risky, and more riskiness gives you the expected more return. And that is why these companies have outperformed the large cap companies and the mid cap companies as well. So that is why we say that over a period of time, the small cap companies can outperform the large cap companies, because over a period of time, a few of the companies from the small cap companies, they come to the mid cap companies. That is having the market capitalization of between 5,000 crores and 20,000 crores. And a few of these mid cap companies come to the large cap companies, that is having a market capitalization of more than 20,000 crore rupees. Okay, so this was basically the CAPA model. So there are a few assumptions of the CAPA model as well. By the few assumptions, I mean like the person like who formulated the CAPA model. So like he basically said that the securities are uh, perfectly divisible. That is, you can divide the securities. That is, you can buy like 1/3 or half or like 1/5 of the shares of the securities. But we all know that is not possible, at least in the Indian market, but that is possible in US, like where you people can buy even the fraction of shares. The second assumption he said that everyone has homogeneous expectations, or like everyone lies on the same utility curve. It means that everyone has the same expectations of return and risk. Like for example, if I think that I'm gonna get like 12% return from the market, my friend of friend, my family members must also think that they would also get the same return from the market. But that is not possible in the ideal scenario, right? And the third assumption that he gave, he said that the market is completely perfect. And by completely perfect, he meant that everything is available to the public, either the public information or the private information. But we all know that not everything is available with the public. Also, the company also keeps some secret private information like with itself. And that certainly creates some opportunities to buy and sell in the market. Then he also said that there are no transaction costs, like no fees is levied or no brokerage charges in the transactions, or like there is no taxes also like in these transactions. But obviously we know there are taxes into these transactions. Like in buying and selling, we have the short-term capital gains tax, we have the long-term capital gains tax, we also have the securities transaction tax, and we have a bit of like brokerage charges also, like whenever we buy and sell, cess surcharge is there. So all these things are present. But still, this model is considered to be like one of the widely used models by the people. Though the assumptions might not stand true in the real life, it might not stand true in the real life, but this formula or this method can help you to calculate the cost of equity in the best possible manner. Okay. That was about the CAPM model.